Good morning. It's Monday, September 15th. Zach Howard back after a little break there last week. Beautiful little trip to Nashville, USA. Great city. Highly recommend this. That means we're back to work, back to markets here today. We're going to go around the globe. Let's start first with Asia, South Korea, and China. Some important macro data here as it relates to potential slowdown in that side of the world. See a big pullback in imports and exports out of South Korea. South Korea, they produce a lot of stuff for the world, particularly on the technology side, chips, etc. They do about 682 billion annually in GDP relative to exports. So that's a significant pullback here, right over month rate of change slowdown from 4.3 to 1.2. And then on the imports, maybe the tariff side is having an impact. Biggest trading partner would be China and the US with South Korea. And it's a very poor data over there in CCP land. Industrial production, big slowdown from a rate of change standpoint there. Unemployment rate ticking up. And this is CCP data, so take that with a grain of salt. It's probably worse than this. Retail sales, big slowdown. China, it is still in a relatively disinflationary environment. The money printer goes burr with the yuan over there more than anywhere else. On to the next phase of that whole debasement, money printer, central bank, monetary policy, Frankenstein, all around the globe. The US, Canada, central bank week this week. We had the Fed and the Bank of Canada looking to cut rates. Bank of Canada, 98, 99% probability of a 25 basis point rate cut here on the week, potentially 50 basis points, but I don't really see them panicking too quickly like that. They're slow to get off the gas, and then they rush themselves and really gets out of control with the economy slowing. Housing market in Canada really depending on that 5-year Canada bond yield, 2.74% yield on that now, which really affects in mortgage rates. And it's now the lowest it's been since April when the tariffs and the panic first started happening there, and the market tried to price in rate cuts, which didn't materialize. Looking at the 2-year yield, which is a proxy for where the central bank in the U.S. here, what the U.S. bond yield is doing, we've taken basically 3 rate cuts from the highs back here last year, more than that, last spring, 4.4% down to that 3.5. Where the market is saying is they're going to cut here in September, they're going to cut in October, and cut again. So rate cuts around the table, which then reflects up in that US dollar weakness. This is the DXY. The biggest components of that DXY is the euro, is the Japanese yen, lesser extent, Canadian dollar, British pound, etc. But it is an easy gauge to look at. The trend here, the US dollar is weakening faster relative to the euro. Okay, and we're at this long-term chart here, 5 years. It breaks 97, which it did earlier today with a 96 handle. It's going to 92 over, I don't know what time, but the trend is the trend, and it's not really seeing the purchasing power of the U.S. Americans, everyday people, is going to get any better unless you have assets. You can measure that real debasement, not in the price of the DXY, but in the price of gold. In all currencies, all fiat currencies are failing. If you look through that lens of gold, all around the world, some just faster than others. As we talked about lots on this channel, the yen, the Canadian dollar is really giving it a run for its money lately. Australian dollar particularly, and the biggest dog out there, like I say, US dollar trying to make up ground. But look at gold's performance year to date. It's not that gold is up 40%. It's not that silver is up 43%. Is that the purchasing power of the fiat, the US dollar, being measured in a real money that's 5,000 year old, a precious metal that is not created at will with man, which is fiat money, is up 40% year to date, massively. Looking through the lens further of gold, GDX talked about last week, massive run in the last couple of weeks here, one of the strongest signals on the board. GDX is up. This is the gold miners ETF, the biggest index of gold miners. You got Newmont, the biggest out there. Anglo, another great company. Wheaton, which is a royalty stream. Barrick, Franco, another royalty. This is the percentage weightings in that ETF. Kinross, great company. I like that one. It's up 28% in 3 months. GDX is 20% in a month, 60% in 6 months. Some of the miners individually have done better than that again. I still like the miners here in this backdrop of debasement, particularly as oil costs, one of their biggest components, is kind of still pretty low here at $60 a barrel, $1.55 a liter for diesel where I live. So those margins continue to ramp higher for the gold miners, which were hated and still are hated by people still chasing AI more than traditional businesses that produce cash flow, like some of these we're looking at. Uh, Other things in my notebook, strong signal after still with the S&P 500, particularly in the Russell Small Cap 2 is showing strong signal. Uh, Biggest news out there. John Law of our day, Mr. Elon Musk, how would a big announcement bought out $1 billion with a Tesla stock over the last few weeks? Boom, the stock's up 7%, the biggest meme coin out there pre-market. He wants his $1 trillion pay package to be the first trillionaire, which really speaks the whole backdrop of this part of history we are in with fiat money, the John Laws every day, central banks, the whole 9 yards. That's what I got for you today. Have a good one. See you soon.